It's 3:47 a.m. on a Sunday morning. You're asleep. You have no idea what's happening. But right now, in the live order books of Binance, Coinbase, and OKX, $657 million in leveraged positions are being liquidated forcibly, automatically, without mercy. 157,000 traders just got their accounts destroyed in a single night. Bitcoin, which was trading at $67,000 on Friday, just hit $63,000. And somewhere in Tehran, a city of 10 million people, explosions are lighting up the skyline. The United States and Israel just launched coordinated military strikes on Iran. And the cryptocurrency market, the only major global asset class that trades 24 hours a day, 7 days a week, is the only pressure valve open on a Saturday night when every stock exchange in the world is closed. Now, here's where it gets interesting. 6 hours later, Bitcoin was back at $68,200. Not in a week. Not after some Fed announcement. Not after a ceasefire. In hours. While bombs were still falling, while retaliatory strikes were already being launched, while oil prices were spiking to $77 a barrel and gold was surging to $5,299 an ounce. Bitcoin erased a $5,000 crash in hours during an active military conflict. And almost nobody explained why that happened correctly. Because the answer isn't what you think. It's not Bitcoin is a safe haven. It's not traders bought the dip. It's a much more specific, much more important story about how Bitcoin actually functions during geopolitical shocks, what the price action reveals about the nature of the asset, and what this event means for every single holder watching this right now. Stay with me. Because by the end of this video, you're going to understand something about Bitcoin that most people, including most crypto commentators, still don't fully grasp. But before we dive into the data that the mainstream missed, I want to see how global this pressure valve really is. Bitcoin was the only market open at 3 a.m. on a Sunday, and I want to see where you were when the world was on edge. I want to see our footprint. Drop a comment right now. Tell me your city, your exact local time, and the weather outside your window. Is it a storm in London, high noon in Dubai, or are the lights still on in Miami, Austin, or New York? Let's see the community that doesn't wait for Monday morning to know the truth. And if you believe that access to this level of real-time financial signal should be a right, not a privilege, hit the like button and subscribe right now. It's the only way we signal to the algorithm that we want truth, not just headlines. Now, let's look at why that $5,000 recovery happened while the bombs were still falling. Let me take you through exactly what happened minute by minute because the sequence matters. Saturday, February 28th, 2026, at approximately 2 a.m. Eastern Time, reports begin emerging from Iran. Explosions near Tehran. Military communications disrupted. Within minutes, the news breaks across every major outlet. The United States and Israel have launched coordinated strikes on Iranian nuclear facilities and leadership compounds. The targets were surgical. Iran's nuclear enrichment facilities at Fordo and Natanz, the headquarters of the Islamic Revolutionary Guard Corps, and, according to reports confirmed by Iranian state media, the compound of Supreme Leader Ayatollah Ali Khamenei himself. By 6 a.m. Eastern, Iranian state television, the same outlet that had been broadcasting propaganda for 47 years, confirmed the news. Khamenei was dead. The man who had led the Islamic Republic of Iran since 1989 was killed in a missile strike near Tehran. The commander of Iran's Revolutionary Guard Corps, Mohammad Pakpour, was also killed. The secretary of Iran's Defense Council, Ali Shamkhani, also dead. President Trump confirmed the news on Truth Social within the hour, calling Khamenei one of the most evil people in history. Now let's zoom in on what happened in crypto markets during exactly this window. Bitcoin had been trading at approximately $67,000 on Friday, February 27th. The context matters. February 2026 closed down nearly 15%, the third worst February in Bitcoin's entire history. Bitcoin was already down 23% from January 1st, and down 48% from its all-time high. This is not a bull market. This is a market that was already wounded before the first bomb fell on Tehran. At the moment the first strike reports hit, approximately 2 a.m. Eastern Saturday, Bitcoin's price began to move, not gradually, instantly. Within hours, BTC had dropped to its intraday low of $63,000. Around 157,000 traders were liquidated in 24 hours, with $657 million in total liquidations. Over the weekend, $657 million in leveraged positions were liquidated, erasing $128 billion in total crypto market cap. Ethereum fell from approximately $1,950 to $1,841. XRP dropped toward $1.28. Solana fell sharply. Every major token dropped in near-perfect correlation. In the stock market, the S&P 500, the bond market, the traditional safe havens, closed. It was Saturday. They opened Monday. This is the first piece of the puzzle. And it's the one almost nobody talks about correctly. Bitcoin is not primarily a safe haven. Bitcoin is the world's only large-scale 24/7 non-closable risk pressure valve. When geopolitical shock hits on a weekend and every stock exchange in the world is locked shut, where does fear go? It has to go somewhere. Money needs to move, risk needs to be priced, panic needs an outlet, and Bitcoin, with its $1.3 trillion market cap and its instant settlement, is the only major asset that can absorb that fear in real time. As Hayden Hughes of Tokenized Capital put it, the real price discovery happens Monday when U.S. equity markets and Bitcoin ETFs reopen. The drop to $63,000 was not Bitcoin failing as a store of value. It was Bitcoin succeeding as a global fear thermometer, the only instrument sensitive enough to register the shock of a Saturday night military operation. But that's just the problem. Here's where it gets really interesting. Now let's talk about what happened after the crash, because this is what nobody explained correctly. By early Sunday morning, within hours of the initial $63,000 low, Bitcoin was trading at $68,200 on Coinbase. The original cryptocurrency rose as much as 2.21% to $68,196 following the news. It was trading at around $67,700 at 11 a.m. in Singapore, after dropping as much as 3.8% the previous day. That is a $5,000 swing, representing roughly an $80 billion move in total market capitalization in less than 24 hours, while an active military conflict was still ongoing, while Iranian retaliatory strikes were hitting targets in Israel and Gulf states hosting U.S. bases, while oil was spiking to $77 a barrel, while the global financial system was bracing for Monday's equity market open, and the mainstream narrative on financial Twitter was Bitcoin bounced because it's a safe haven. That's wrong. And understanding why it's wrong is the key to understanding what Bitcoin actually is. Let me give you the correct explanation, because it has three distinct components, and each one matters. Reason, number one, the de-escalation signal. The confirmation of Khamenei's death, counterintuitively, was read by markets as a potentially shorter conflict. Think about this carefully. The uncertainty before confirmation was maximum. Once the death was confirmed, the scenario tree collapsed. The conflict now had a known endpoint: Iran's constitutional succession process. A regime in transition is not a regime in a position to escalate indefinitely. Analyst Ash Crypto wrote on X as the rebound began, Bitcoin and Ethereum are pumping hard. They have fully recovered. Marcus Thielen, head of research at 10X Research, confirmed this. Traders generally don't expect the Iran conflict to have major negative economic consequences. The market was not ignoring the war. It was pricing the duration of the war, and pricing it as finite. Reason number two, the leverage clearance effect. Here's the part that almost nobody mentioned, but that professional traders understood immediately. Bitcoin entered this event with 22 consecutive days of extreme fear readings. Open interest was already at low levels from months of prior deleveraging. As Bitcoin has documented, much of the forced selling and deleveraging appears to have occurred before the strike. When you enter a shock event with leverage already cleaned out, the shock doesn't create a cascade of forced liquidations. The liquidations were split roughly evenly between leveraged longs and shorts. Both sides got liquidated, which means neither side had overwhelming directional control. This is critical context. The $63,000 low was not a fundamental repricing of Bitcoin's value. It was the bottom of a fear-driven leverage clearing spike in a market that was already close to exhausted on the downside. Reason number three, the whale signal. On February 28th, one whale moved 6,318 BTC, worth $425 million, to Binance in a single transaction. This was part of an 11,318 BTC inflow on a single day. At $761 million, it was the largest inflow since January 2021. Large Bitcoin inflows to exchanges can mean selling pressure or institutional positioning. Given that the move followed rather than preceded the crash, the more likely interpretation is institutional accumulation at crisis-level prices. On-chain data from CryptoQuant told an even clearer story. The short-term holder SOPR had fallen below 1.0. This means recent buyers were selling at a loss just to exit, a textbook bottom formation signal. The MVRV ratio had compressed to approximately 1.17, down from 1.24. The 365-day MVRV was at minus 11%, placing the spot price 11% below the network's average acquisition cost. Historically, this combination of SOPR and MVRV readings has preceded major cycle recoveries. In plain language, the on-chain metrics were screaming bottom formation at exactly the moment when the mainstream narrative was screaming war. The whales read the data, the retail traders read the headlines, and those two groups made opposite decisions at the same price level. Transition, lean back, slower cadence, philosophical mode. But here is the deepest part of this story. And this is the thing that nobody told you. The $63,000 low and the $68,000 recovery are not primarily about Iran. They are about what Bitcoin is, at a fundamental level. We live in a world where geopolitical instability is becoming the baseline rather than the exception. To understand that, we need to look at the other story buried inside this event. It is the story that had nothing to do with American and Israeli jets and everything to do with what ordinary Iranians were doing at 3 a.m. while explosions lit up their city. While 157,000 leveraged traders were getting liquidated on Binance and Bybit, something completely different was happening at Novitex. Novitex is Iran's largest cryptocurrency exchange. It processed $7.2 billion in transactions in 2025 and has more than 11 million registered users. In a country of 90 million people, that is roughly 12% of the entire population on a single platform. In the minutes after the first strikes hit Tehran on Saturday night, outgoing cryptocurrency transactions from Novitex increased 700%, according to a Monday blog post by the blockchain analytics firm Elliptic. Read that again, 700%. Not 70, not 7. Elliptic linked this spike to a pattern documented during previous sanctions and internet blackouts. Iranian citizens use crypto as a capital flight mechanism whenever the situation becomes existential. But the February 28th spike was the largest and most immediate they had ever recorded. Where was the money going? Funds moved toward foreign exchanges operating outside Iranian jurisdiction, privacy-focused protocols, and non-KYC platforms. And what were they converting to? This is the detail that matters most. According to Chainalysis head of research Eric Jardine, the flight to safety effects are largely confined to BTC, suggesting that in a time of crisis, that is the preferred safe haven asset for civilians in Iran. Not stablecoins, not Ethereum, not XRP, Bitcoin. Why? Because Bitcoin, unlike USDT, which is controlled by Tether and can be frozen at government request, is genuinely unstoppable. While the Iranian central bank accumulated at least $507 million in USDT in 2025 to steady the rial, the effort failed. The Iranian rial has lost more than 96% of its value against the US dollar. 96%. The ordinary people, who had no access to dollars, no foreign bank accounts, and no way to move wealth across a border that was now a target, turned to Bitcoin. It worked when everything else was corrupted or destroyed. The Iranian state itself mines BTC at an estimated cost of $1,300 per coin to evade sanctions. Inflows to IRGC-linked addresses totaled $2 billion in 2024 and exceeded $3 billion in 2025. This is Bitcoin's actual use case. Not a speculative token for American traders, but financial infrastructure for populations under siege, whether military, economic, or political. The 700% spike in Novitex outflows represents the removal of Bitcoin from the liquid float into cold storage. It is not selling pressure, it is accumulation. Every rial of panicked capital that converted into Bitcoin is one less coin available for the market in the future. And there were a lot of rials in motion on Saturday night. Here's where I need to give you the historical context, because the Iran event isn't an anomaly. It's part of a documented, repeatable pattern that goes back to Bitcoin's earliest major price events. And once you see the pattern, the $63,000 to $68,000 move in 6 hours stops looking like chaos. It starts looking like clockwork. The pattern. Geopolitical shock. Immediate crypto sell-off. Recovery within days to weeks. New higher base. Let me walk you through the data. On October 7th, 2023, the Israel-Gaza conflict began. Bitcoin briefly fell below $27,000. Within 50 days, Bitcoin had fully recovered and was trading above pre-crisis levels. The conflict that most market participants expected to be bearish was ultimately irrelevant to Bitcoin's long-term trajectory. In June 2025, Israel launched Operation Lion Rise on Iran. Bitcoin fell roughly 6% in the immediate aftermath. Over the following 2 months, Bitcoin rallied 62%. The pattern held. The fear was acute, but the recovery was persistent. Now compare those prior events to February 28, 2026. The June 2025 Iran strike was Israeli only. The February 28th strike involves the full weight of the United States military. A different escalation. And yet, 6-hour recovery from $63,000 to $68,000. The panic was fully erased in under 24 hours. The recovery was faster this time, even as the scale of the event was dramatically larger. Why? Arthur Hayes, co-founder of BitMEX, provided the framework. When geopolitical tensions escalate and government spending expands, accommodative monetary conditions often follow, Hayes explained. These conditions may significantly impact risk assets such as Bitcoin. The Gulf War of 1990 to 1991. The Fed lowered interest rates multiple times. They chose accommodation over restraint despite inflationary pressure from oil spikes. Post 9/11. The Fed accelerated its rate-cutting cycle almost immediately. Every major U.S. military escalation in the modern era has forced monetary accommodation. War is expensive. A multi-week campaign against Iran's infrastructure costs billions. That spending expands the deficit and creates debt issuance pressure. That pressure pushes toward rate cuts, QE, or both. And every major monetary accommodation event in the last 15 years has been followed by a Bitcoin bull market. Hayes' actual recommendation, a more cautious approach, is to wait and observe. The right time to significantly enter is after the Federal Reserve lowers interest rates. That's not speculation. That's pattern recognition backed by 35 years of Federal Reserve behavioral data. And here's the meta point that ties everything together. Bitcoin fell to $63,000 because it is a risk asset in the short term. Correlated with fear, uncertainty, and the instinct to de-risk, Bitcoin recovered to $68,000 because it is sound money in the medium and long term. Every event that drives short-term fear also drives the monetary accommodations that makes sound money more valuable. The crash and the recovery are not in contradiction. They are the same phenomenon expressing itself across two different time horizons. Understanding which time horizon you're operating on is the single most important thing you can do as a Bitcoin holder in this environment. Green Part 5. Solution. What you should actually do right now. All right, let me give you the framework that actually matters. Everything I have described so far is context for a decision you need to make. What this event tells you about Bitcoin's current position. Bitcoin entered the Iran strike at its most technically oversold level in history. The weekly RSI had hit its lowest point ever recorded. The fear and greed index had been in extreme fear for 22 straight days. Open interest was near multi-year lows, meaning the leverage that causes catastrophic cascades had already been burned off. Bitcoin is already down 48% from its all-time high. It is on track to close its fifth consecutive red monthly candle. The leading cryptocurrency has also recorded its worst start to the first 2 months of a year, falling 24% since January. February closed 14.8% below its open, making it the third worst February in Bitcoin's history. That context is critical. The people who sold at $63,000 were mostly not selling because of Iran. They were selling because they had been holding a 48% down asset and could not handle one more night of bad news. The Iran strikes were the trigger that released pressure that had been building for months. That kind of selling, capitulation from exhausted holders, is historically one of the most reliable entry signals. Not because of the geopolitical event, but because of the seller profile. CryptoQuant data shows the short-term holder SOPR had fallen below 1.0. This means recent buyers were selling at a loss just to exit, a textbook bottom formation signal. On-chain, the signal was clear. Structurally, the setup was as washed out as Bitcoin has ever been. The Iran event simply made the psychological pain acute enough for the final wave of capitulation to complete. The three-scenario framework. Here is how to think about what happens next without predicting anything. Scenario 1. Contained conflict, short duration. Iran's constitutional succession process takes 30 to 90 days. New leadership, absent Khamenei's personal authority, may be more inclined to negotiate a face-saving exit from confrontation. If the conflict de-escalates within weeks, the fear premium in all risk assets collapses. Bitcoin's correlation with traditional markets reasserts, and the $63,000 bottom looks like a generational entry point. Scenario 2. Prolonged engagement, expanded spending. Trump vows a 4-week campaign. Congress appropriates emergency defense funding. The deficit expands, and the Fed faces pressure to accommodate. Treasury yields rise, and financial repression follows. The playbook Hayes documented for every prior Middle East engagement repeats. Bitcoin, as the fixed supply asset, outperforms over the 12 to 24 months following the accommodation pivot. Scenario 3. Strait of Hormuz blockade. Global oil shock. Iran's Revolutionary Guards launch sustained operations disrupting the world's most important oil choke point. 20% of global oil supply flows through the Strait of Hormuz. Oil goes to $100, $120, or $150 per barrel. Global growth craters and equity markets collapse. In this scenario, Bitcoin initially sells off with all risk assets. Ultimately, it becomes one of the few assets whose supply cannot be inflated to respond to the crisis, positioning it for long-term outperformance. Note what is common across all three scenarios. The medium to long-term direction for Bitcoin is the same. The short-term volatility is different, but the 12-month destination is the same. The practical moves. 1. Understand the difference between Bitcoin as a fear thermometer and Bitcoin as sound money. The $63,000 crash was the thermometer. The $68,000 recovery was the money. 2. On-chain data is your edge. When SOPR falls below 1.0 and MVRV compresses, smart money is accumulating and retail is capitulating. 3. Watch the Fed, not the battlefield. Bitcoin's recovery trajectory will be determined more by Jerome Powell's next press conference than by anything that happens in Tehran. If the Iran engagement forces monetary accommodation, rate cuts, or balance sheet expansion, the Bitcoin bull case strengthens dramatically. If the Fed stays hawkish, Bitcoin faces continued pressure in the short term, even as the long-term case builds. 4. The Iranian citizens' playbook is the ultimate stress test for Bitcoin's value proposition. 700% outflow spike at Nobitex, Rial down 96%. Capital flight to Bitcoin cold wallets. Is Bitcoin working exactly as designed in exactly the circumstances that matter most? Every time that story repeats, it strengthens the long-term demand base in a way that no ETF launch can replicate. Let me close with the one thing I want you to actually remember from this entire video. On Saturday night, February 28th, 2026, at 3:47 a.m. Eastern Time, while every stock market in the world was closed, the Bitcoin market was open. While every bond market was dark and political leaders were scrambling to understand Tehran, the digital ledger was already pricing the future. It fell to $63,000. It absorbed 157,000 liquidations and processed $657 million in forced closures. It reflected the full weight of a geopolitical shock that traditional markets would not be allowed to price until Monday morning. And then, while bombs were still falling and retaliatory strikes were still happening, Bitcoin recovered. Not because the war was over, but because the market concluded. This is survivable and this is finite. The 700% spike in Iranian crypto outflows told you what Bitcoin is for people who actually need it. It is not a speculation for them. It is a lifeline in a collapsing reality. The $63,000 to $68,000 recovery told you what sophisticated participants think about Bitcoin's long-term position. The on-chain data told you exactly what the whales were doing while retail was selling in a panic. 3 signals, 3 different data sources, all pointing in the same direction. Bitcoin is not a perfect asset, nor is it a short-term safe haven in the traditional sense. It is the most transparent expression of the human demand for sound money. In a world driven by missile strikes, debt refinancing, and yield bans, that demand is not going away. The night markets told the truth. The question is whether you were listening. But before I go, I want to talk to you specifically. The average person watched less than 5 minutes of this video before clicking away for something easier. But you stayed for the whole investigation. You sat through the Nobitex outflow data, the SOPR bottom signals, and the history of Federal Reserve wartime accommodation. That means you're not just a trader, you're a researcher. You have the attention span that Wall Street and the central banks count on you not having. You are officially part of the 1% who actually knows how the machine works behind the curtain. If you made it to this final second, I want you to leave a comment with these 4 words. The math never sleeps. And right next to it, drop the price 63K if you were watching the charts live when the first bombs hit. I read every single one of those. Hit the like button and subscribe if you want me to keep going deeper on this. This conflict has chapters left to write. Stay vigilant. I'll see you in the next one.